Imagine waking up at 65, opening your brokerage account and seeing a deposit hit your account, not because you sold anything, but because your investments paid you. No panic selling during a market crash. No wondering if your savings will last 20 more years. Just cash, showing up like clockwork, whether the market is up or down. Now, imagine the opposite. You retire with a decent nest egg, but every withdrawal means selling shares, even during a downturn. Your balance shrinks a little more every month, and you start doing math you never wanted to do. How long will this actually last? The difference between those two futures usually comes down to one decision made years earlier. Whether you built a portfolio designed to pay you, or one you simply hoped would grow forever. Today, we're fixing that.
If your goal is to build reliable retirement income and live off your investments, not your savings, you're in the right place. Today, we're breaking down exactly how to build a dividend portfolio for retirement, step by step. This matters because most people plan for retirement savings, but very few plan for retirement income. And those are not the same thing. By the end of this video, you'll know how to set a real income target, which types of companies actually belong in a retirement portfolio, and one mistake that quietly wrecks dividend portfolios even for experienced investors. Stick around, because that mistake shows up later, and it's more common than you'd think. You'll walk away with a practical framework you can start applying today, even if you're just getting started. Let's start with the number most people skip, your actual income target. Say you estimate you'll need $60,000 a year in retirement. Social Security or a pension might cover $25,000 of that, leaving a $35,000 gap. That gap is what your dividend portfolio needs to fill. Here's where the math gets real. If your portfolio yields 4% on average, you'd need roughly $875,000 invested to generate that $35,000 a year. That number might sound intimidating today, but it's not meant to scare you. It's meant to give you a target, because a portfolio built around a specific number behaves very differently than one built around vague hope. This is also where a common trap shows up: chasing yield. A stock paying 9% sounds better than one paying 3%, right? Not necessarily. Ultra-high yields are often a warning sign. The market is pricing in a dividend cut, financial trouble, or an unsustainable payout. A 3% yield that grows 8% a year will often out-earn a 9% yield that gets slashed in half during the next recession. So the real question isn't which stock pays the most today. It's which company can reliably pay and grow that dividend for the next 20 years. That single mindset shift is the foundation everything else in this video builds on. If you're finding this helpful and want practical videos on dividend investing, retirement income, and building long-term cash flow, consider subscribing. I publish new videos every week to help you invest with more confidence. Now, let's talk about how to actually build this thing. Step 1. Prioritize quality over yield. Look for companies with consistent earnings, strong free cash flow, a payout ratio generally under 75%, and manageable debt. A payout ratio that's too high leaves no cushion. One bad year and the dividend gets cut. Companies with decades-long streaks of raising their dividend, often called dividend aristocrats, are a good starting hunting ground, though they're a starting point, not an automatic buy list. Step 2. Diversify across sectors, not just companies. Owning 10 stocks means nothing if they're all banks. If interest rates or regulations hit that sector, your entire income stream wobbles at once. Spread holdings across sectors like healthcare, consumer staples, utilities, industrials, and technology, so no single economic event can take down your income. Step 3. Automate contributions and reinvest early. During your working years, reinvesting dividends buys more shares, which then generate more dividends, compounding on top of compounding. This is the quiet engine behind most large dividend portfolios. It just needs time. Step 4. Shift from reinvesting to collecting as retirement nears. In the years before you retire, you'll gradually turn off reinvestment so those dividends start landing in your bank account instead of buying more shares. This transition doesn't need to happen overnight. Many investors phase it in over their final working years. Each of these steps builds on the last. Quality protects the income, diversification stabilizes it, consistency grows it, and the reinvestment shift finally lets you spend it. Let's make this concrete with a sample portfolio. Picture a $500,000 portfolio spread across 5 sectors, 25% in consumer staples, think household goods and food companies, 20% in healthcare, 20% in utilities, 20% in industrials, 15% in dividend-focused ETFs for broad diversification. If this portfolio averages a blended yield of 3.8%, that's about $19,000 a year in dividend income, without selling a single share. Now assume the portfolio's underlying companies grow their dividends by an average of 6% annually. In 10 years, that same $500,000 could be generating closer to $34,000 a year, even if you never add another dollar of new investment. That's the power of combining yield with dividend growth instead of chasing yield alone. I'm curious, what's your retirement income goal? Drop it in the comments. Seeing real numbers from other investors is often more motivating than any spreadsheet. Even careful investors fall into a few predictable traps. Mistake 1: chasing yield without checking sustainability. We touched on this earlier, but it deserves repeating. A payout ratio above 90% or a yield that suddenly spikes is often the market warning you before the company confirms it. Mistake 2: over-concentrating in safe sectors. Utilities and telecom feel stable, so investors overload on them, then get blindsided when rate changes hit those sectors hardest. Mistake 3: ignoring dividend growth rate. A stock yielding 2% today, but growing that dividend 10% a year can outpace a stagnant 6% yielder within a decade. And here's the mistake that catches even experienced investors: stopping the review process once the portfolio feels built. Companies change. A stock that was rock solid 5 years ago may have taken on new debt or lost its competitive edge. Skipping regular reviews is how quietly deteriorating holdings go unnoticed until the dividend cut announcement. Let's bring it together. Start with a clear income target. Choose quality companies over high yields. Diversify across sectors. Contribute consistently and reinvest while you're still working. Review your holdings regularly. And be patient. Meaningful dividend income is built over years, not months. Follow that framework, and you're not just hoping your portfolio works in retirement. You're building it too. Thanks for watching all the way through. That means a lot. If this helped you, hit like, subscribe, and share it with someone planning their retirement income. It genuinely helps this channel grow. If you're wondering exactly which funds can simplify this whole process, watch The Best ETF Mix for Monthly Dividend Income, Simple 3-Fund Strategy next. It's the perfect follow-up to what we covered today.